Hey there, welcome to the channel. So today I want to talk about short interest. Okay, so we got short interest data as of May 27th, at least as reported on the NASDAQ. And so what I want to look at is the various short interest and who is leading that. Quite honestly, I saw a Meet Kevin video about this. So I just wanted to take a look. I could see like, okay, what shares he's looking at or what companies are highly shorted and just want to take a look for myself. So I want to look at a couple of things. So I just took like the most shorted companies as a percentage of float. And this is, it tends to be like an important way to look at it, right? Because, so let's start out. What does it mean to short shares? When you short shares, what you're doing is you're borrowing them and selling them. Now, what that means is you're short the shares, but it means you owe them and you don't own them, but you have to return them to someone. So, for example, if I wanted to short Beyond Meat, I would go to my broker and I would borrow the shares and I would sell that 100 shares of Beyond Meat. Now, it would cost me money to do that. Not only there's fees for doing that, and there's like certain percentage that you're charged to do that. So it's costing me money, and it has what you call that negative carry cost. It's costing me something to have those shares short. Now, what I'm betting on is that the price of those shares go down. So let's say I shorted Beyond Meat at 100 and then it goes down to $50. Then I go out and I buy those shares on the market for $50 and I basically return the shares back to the broker. If I do that, then I made a profit of $50, right? Because I sold them and collected $100 a share. I bought them back for 50. The net minus all the fees and everything else, I get to keep. So you basically profit when the market's going down. Now, the issue is as more and more shares are shorted, when it gets to a specific or when it gets to a significant amount of the float. So the float is the number of shares that are out there. So like you have a company, take a company like Pepsi or whatever. They might have 1 billion shares out there floating, meaning there's 1 billion shares out there for trading that's out there. Now they might have even more shares that might be non-public shares or shares that are locked up in some kind of agreement or whatever, but they're not out there trading. So what that means is the float is the amount of shares that are being traded and that can affect the price. So you can imagine now if you have a large amount of shares short relative to the float, that if the people shorting wanted to cover their short positions, then they have to go out and buy that. So when you're looking at it and you see like, okay, Beyond Meat, 45% of the float is short, that's very significant. That's a very high short interest in the stock. And the implication there is that almost half the shares out there that are floating around, that are trading, are shares that were shorted. And therefore, someone owes those shares to someone else. Someone has to go out and buy 45% of the float at some point and return those. Okay, that's kind of the implication here. So I'm looking here. What I did is I just kind of checked all these tickers. And then what I did is I kind of looked at the earnings state, because one of the things, notice when you look at a lot of the earnings, there's a lot of volatility very often, especially with some of these companies here, looking at these kind of NASDAQ type companies, not huge floats, not blue chips. These are not blue chip companies generally. And so therefore, those companies can have volatile earnings. Take recent cases, Walmart, Target. These companies those are big blue chip type companies, and they had huge moves on earnings. So the point is, that's why I looked up when the earnings are due, because this could be the pressure point. If you're out there and you're one of this 45% of the float and you're holding some of that 45% of the float and earnings are coming up, what are you looking at? Are you looking at like, do I really want to hold the earnings and find out that they had some kind of good news come out and it starts going up and then I have to race to cover? Or do I want to take that risk? Do I want to take that chance? So that's why the earnings date can be important. And what I will say is I look these earnings dates up and these do change. So if you're playing the game, remember, this is not financial advice. I'm not giving you financial advice. I'm not telling you to do anything. Okay. I'm just showing examples of some of the things that I look at. And I can tell you, if you're someone playing short squeezes and you're a trader out there, you're probably looking at 10, 20 other things, a whole bunch of other things. But I'm just giving you my perspective, the kind of things that I look at. So the point is, as it comes to the earnings, and most of these now are in, basically, we have some time right now. Okay. So we have some in June, and then we have July and in August. But August is going to be really busy for the reporting of all these guys. So that's where, by then, these people have to make a decision. Do they want to keep these shorts out there, or do they just want to cover? So that's the first thing. Next thing is I kind of looked at sort of fundamentals, and I just kind of graded them myself in terms of fundamentals and accumulation, whether these are high quality or low quality stocks. And I just kind of give them an A through D rating. If you have companies with very low volume, this is under a million shares. This one here, 677,000 a day. The less volume they have on a daily basis is they're more susceptible to moves. They're more susceptible to small amounts of shares affecting the price. And when you're talking about 34% of the float is short, and it only trades that much, you have that potential for maybe outside moves if people that are short come in and try to cover. Now, the other thing is I looked up on NASDAQ, and you can go there and look, and you can get the days to cover, and you also can get like a chart of like the last year or so of short interest, which is reported, I think, twice a month or something like that. And so you can get a really good idea. And that's what I would encourage you to do. If you were looking at it, then you would go also, get the chart of the company you're interested in thinking about. You'd want to look at that and try to, chart it to see if the short interest is going up, is it going down, and all the things like that. But days to cover is basically your average volume over the number of shares short. Right. So if your average volume is 1 million shares a day and you have 10 million shares short, then it's going to get 10 over 1, which is going to take 10 days for you to cover. And that would be if the entire volume of the day is used to cover shorts. Right. So it's an indication. The higher the days to cover is an indication of how much of a squeeze could be applied. So here we see like days of 4, 7, 7, and this one's really high on GoGo, 18 days to cover. And it's got a high average volume, so it's kind of interesting. It's also got an A+ rating, so that'll be interesting to look at. But you can see you have all these ones. So if you're looking at a short squeeze, the implication would be the more shorts, the higher the percent shorted, in addition to based on the volume versus that number of shares, meaning like what is the higher days to cover. These would be the kind of things that I would look at in my case to say, where's a potential short target? Now, let's go look at the charts for some of these. Okay, so the first group of stocks that we're going to look at that we were talking about is the ones that are more highly rated. So we have, for example, GoGo here. So this one was more highly rated, but it had significant short interest. Now, what's interesting here, this thing's in an uptrend. This is a weekly chart. And it actually had a really good week last week. So it makes you wonder a few things here. So if I was looking at this, why would this is a case where apparently it seems like someone's out there, they're out there trying to short this stock, and they're like, they must be looking at the fundamentals to say, hey, this stock is not worth it. And they're kind of trying to short a stock that is going up. So of course, if I was to look at this now, of course, you have to look at the detailed prices and dates, but you can get an idea that a stock like this, what's happening is that the shorts might be hurting. They may be putting on shorts, and it keeps maybe moving against them. And it also makes you wonder if some of these, very sharp moves that they've had in this stock are shorts like running to cover. So this is one of the cases you have, famously people have, there's many people that have shorted Tesla for years and just lost their shirt. GoGo sounds like maybe it's something. This is not moving as much of that by any means, but it could be a situation where that is the case. So, shorting it, the issue here might be, and I'm using very vague words like might be, could be, because I don't know. But the issue here is, if you were looking for a short squeeze, the question might be like, okay, the stock is moving up. Are the shorts right in some way? And if this goes to earnings, is it going to have like a really bad day and go down 20% because they know something that you don't know? So, I mean, that might be the risk there. It's on its way up. It's had significant moves. Looking back from a year and a half ago, it's at $3 and it's at $21. So you 7x move. So it's up significantly. So that's just one thing to keep in mind with that if you were to like enter on that. ICPT, this one here is another, like, this is an interesting one. This is a more highly rated stock in terms of its earnings and that kind of stuff. But look, it's gotten the crap kicked out of it. And look over here too. This guy, huge gap. So I don't know, but I assume this was earnings and it just did not go well. Now, here's the thing. If you look at this, and this has got a high short interest like all these do, if you're looking at it, well, maybe this would be a possible better short squeeze. A couple of things. Generally, if you're looking at it, more of the shorts than not, you would think, and that may not exactly be the case, but you'd think that they're probably made some money on it, right? Because if you were here and you shorted it, you made some money here, here, here. Now, if you're really pressing it hard in this flat base, you may not be up much, but you may not be down a lot either. And then on a side note, this is actually forming a base and you just had a bullish cross on that. That's something to kind of be interested. So, this is a very interesting chart here. Interesting that it's got a high short interest. So it's possible it could be a short squeeze kind of candidate because, two things. One, shorts would like to probably take profits on it. They probably made some money, or some of them have, and be like, okay, look, it's not going down anymore. Time to cover, get out. The next thing is earnings coming up. You don't want to be around earnings taking any kind of a chance. And gee, how much do you want it to go? I mean, is it going to go bankrupt? I don't know. Maybe. Let's see. VTNR. Let's look at this other guy. This was another highly rated one. Now, in this case, the stock's going up. Same kind of thing applies as before. It seems like, someone's like, hey, this is way overvalued into shorting it. And could that be the case? I mean, maybe it could be the case. Going into earnings, a risk. Now, maybe there's less risk to the upside that it would pop up a lot, given that it seems like it's up a lot, even though this chart doesn't look that much. You were at $3, $5, you're at 15. That's a 3x move in a period of 6 months. So it had some big moves. So that's kind of in that play where you're just like, which way is it going to go? And then Arch Energy. So this is a coal company. So the coal, look, all the energy stuff, a lot of that stuff has moved up a lot. And you can make the argument like coal, look, has not been a great business. And you could probably do a lot of analysis and figure like, hey, it's, due for coming down, except you could be playing against a commodity cycle. The Russia thing is not resolved. So just kind of something to keep in mind. Now let's look at some of our other dog meat. So Big Five Sporting Goods, this guy, has come off a bit. I mean, really volatile and coming off, high short interest as well. So this may come under the play, maybe the shorts have some profit in it. Maybe they'd want to cover, maybe they want to push it. I don't really know. Hard to say. Beyond Meat, this was the wonder child of the, of the fake meat fad. I'm going to call it a fad. This thing is way off. And once again, now what's interesting from this one as compared to that other chart I showed you, which was for, I forget which company it was, that had the base here, it's in just a solid downtrend. So this one, short squeeze on it, I mean, maybe, but there's not really a reason for these guys to cover except the fact that when earnings come up, whatever, a month or two from now, maybe people just want to get some profits and take profits out of there. So this one, quite honestly, Beyond Meat, it kind of looks promising. No, it doesn't look promising to me, because my view is, look, it's there's no base, there's no blah blah blah. It's like, so it's like, if you were short and had a lot of resources, maybe you wouldn't cover. Maybe you'd be like, I'm going to ride this thing for a while. City trends, this guy, this is a really volatile chart. Um, once again, though, this thing is kind of basing out. And, it's kind of interesting because when you get down to these places where you get like it's starting to base, it's kind of a risk and in really high volumes. And see, notice how your volumes really spiked here. So, this, in fact, these huge volume spikes may be, shorts actually covering in there, and that's one of the things to watch. If you looked at it and you said, hey, you got 10 days to cover at the average volume, but look at the volume went from 2 million on average to 5 million. So your days to cover, just got cut in more than in half. So kind of keep that in mind. So, that's one of the things. So you want to know what you're trading it for. If you're just doing a quick trade, whatever, you want to see that pop and you're done, then that's what you're doing. Set your goal. You do what you want to do. Hash Corp, this one fundamentally was really poor. A new entrant here. I don't know. You can see that there's, it's someone seems to be supporting it around this low. So basically it had gone public, came down, and they're really supporting it here. If it breaks lower, I mean, hash, what is a hash? Don't talk to me about hashes and you crypto guys and you're hashing mega hash this, mega hash that. I mean, she's, it's not a business model. Okay. This therapeutics one, this is another one that's just in a downtrend. So from my perspective, which I could be wrong, is I would be less likely to pick this guy because, hey, the downtrend is continuing. I don't see that base. You always have your cycles, right? We always have our cycles in the stocks. At some point, there'll be some kind of a basing. And then it will go and you go into an up move, and then there'll be some kind of topping, and then it will go down, and then it'll be another basing. So these are the cycles of stocks. These are the cycles. And where are we now? Looking at this chart, we're in this part here. We're coming down. And are we here where we're going to start to form a base? Or are we like over here? The answer is we don't know. So that's why those are, less on my, don't look as good to me. This guy intercept, yeah, and this is the chart with the huge base, and you see that bullish stuff. See that crossover over there? Like, all right, let me just go here. Look at this little crossover. You see that your 50-day moving average crossed the 200. So now when I look at it, and now when I look at it on a daily, it's like, oh, this thing is ugly though. Really volatile, sloppy chart, but it does seem to be kind of basing. I want to look at this lemonade. Where lemonade, another short. This was one of Kevin's favorite ones back in the day. And this is what happens to all these stocks, here at IPO, came up, had a huge run. And so you're always stuck trading. You're not investing. I mean, reminiscences of a stock operator. Read that book and understand and really look at it. It was back in the late 1800s to 1900s, kind of the time frame it was written in. And it was written in based on the guy, the great bear of Wall Street, what's his name, Livermore. But look at it, really look at that, because the stuff that was going on at that time, it's really not much different now. It's really not. So my point here is on this guy, kind of downtrend. Now I could make an argument. You see, it's like maybe it's starting to base here. So maybe there's something here, maybe on this lemonade, if this thing is starting to base. And so what's going to happen here? If it, maybe the earnings aren't so bad and they get a pop in the earnings. Maybe this starts basing out and start breaking up. Maybe the shorts start actually breaking it above this point here because they start coming in and they're like, oh, I don't want to hold this thing for earnings. So, it sort of has potential. And then, how do I look at a short, like interest pop or a short squeeze? How do I look at it? Well, I'm not looking at it any different than I look at any other stock. I'm looking to find a base. I'm looking for, a stock has come down and it's finding a base, or whatever. I mean, I'm looking for something that's trying to find some kind of base. It could be anything. It could be, inverse head and shoulders, could be cup and handle, all kinds of crap. It doesn't really matter. It's just an area where you find enough support and you start breaking out in the 50 and the 200 cross to the plus side. So it's really the same thing. So now, when you're looking for a short interest, if you compare this chart and you compare, I want to look at this chart, yeah, this chart here is not great, but you don't have a base yet, right? You're still just going down. You're still just on the way down. So you don't have much of a base to hang your hat on. So that's kind of something to keep in mind. Here, this is a new one, Verve Therapeutics. Wow, it's, really interesting. Just gave up, that was the IPO price in that range, call it 18. They're below there. This one could form a base, it could, but it hasn't yet. So once again, looking for that base to confirm it or anything, not really there. And, this is the thing. I know everyone loves to be early. Everyone loves to be early on this stuff, but what happens is, this is what happens. You're so early that you're wrong on too many moves and you give up money. So when out of 10 stocks, if you're trying to be early all the time, then you're wrong too often. And then so when you will find that you'll be early and you'll get it right some of the time. But when you do and you get it right, then it doesn't make up for all the losses for all the times you're wrong. So it's all like a batting average in baseball. It's all like statistics of a casino. What is in your favor? What is the odds in your favor? It's that kind of thing. The odds in your favor are like, look for a base. This to me, and just my view, is like, this is a perfect example of something that I wouldn't be interested in a short interest on, because if I look at this guy, the reason is why. Well, it might have a very high short interest, but the issue that you have is it's still just trending down, and I don't see much of a base. Here, low, lower highs, lower low, and it just recently put in a new low. So what does this have to do? Well, this really has to find that floor, and it starts having to put in some kind of base. And then at some point, you have to start getting that little bit of, look, there's a low, oh, a little bit higher low, and then you start getting the higher highs. You got to start getting that behavior, and then you'll see as well that those moving averages will cross over. First the fast moving average will start turning up, and then your really slow moving average is like over here, and is over here. And then so at some point, you cross, your fast one crosses over, and this would be the bull cross, and this would be like the 200, and this guy would be like the 50, something like that. And so that's kind of what we're looking for. And so, here I don't see that. So at the same time that I'm looking for plays, I'm looking for trades, and I'm looking for short squeezes that I can play, I'm looking for bases. I'm looking for something that, hey, can make a move for me. And then, the way it really works. I mean, the way it really works is, there's so many different strategies and technical indicators. There's hundreds of them. And, the more of those you can get to line up in your favor, if you can line up the fundamentals with the technicals, with what's happening in the market, with the Fed and the more of the stars you can get to line up, the better success you'll have. So that's my thought on short interest. Talk to you later. Bye.